Have you ever heard of the dot-com bubble? It was a crazy time in the late 90s when it felt like anyone with a half-baked idea for a website could become a millionaire overnight. But just as quickly as it inflated, it burst, leaving a trail of failed companies and fortunes lost. So, what exactly happened? And what can we learn from it today? Let's dive into the story of the dot-com bubble. Our story begins in the mid-1990s. The internet was just starting to go mainstream. People were getting online for the first time, hearing that iconic dial-up sound, and discovering a whole new world of information and connection. This new technology, the World Wide Web, was revolutionary, and it sparked a wave of incredible optimism. Investors, both big and small, saw the internet as the next big frontier, a digital gold rush. They started pouring money into any company with a .com at the end of its name. The thinking was, get in early, because this is the future. The media fueled this frenzy with stories of young tech founders becoming billionaires. There was a genuine belief that old business rules no longer applied. You didn't need profits, you didn't even need a clear business model. All you needed was a cool domain name, a catchy idea and eyeballs. That is, website traffic. The mantra was get big fast. The idea was to capture a massive user base first and worry about how to make money from them later. This led to some truly wild business ideas. Companies like Pets.com, which promised to deliver pet supplies to your door, became household names. They spent millions on advertising, including a famous sock puppet mascot that even appeared in the Macy's Thanksgiving Day Parade. Another company, Webvin, aimed to deliver groceries within They built massive high-tech warehouses and bought a fleet of delivery vans. On paper, these ideas sounded amazing. In reality, they were burning through cash at an astonishing rate with no path to profitability. The stock market reflected this euphoria. The Nasdaq Composite Index, which is heavy on tech stocks, skyrocketed. It climbed from under 1,000 points in 1995 to over 5,000 by March of 2000. People were quitting their day jobs to become day traders. It seemed like easy money. You could invest in a tech IPO, an initial public offering, and watch its stock price double or triple on the very first day of trading. The excitement was contagious, and a classic speculative bubble was born. Everyone was buying, not because the companies were fundamentally valuable, but because they believed the price would be even higher tomorrow. This is what economists call the greater fool theory. You can buy an overvalued asset as long as there is a greater fool willing to buy it from you at an even higher price. But bubbles, by their very nature, cannot last forever. In early 2000, the party started to come to an end. A few things happened. Central banks, like the US Federal Reserve, started raising interest rates to cool down the overheating economy. This made borrowing money more expensive and made investors a little more cautious. At the same time, some major tech companies, like Microsoft, faced legal challenges, and some high-profile dot-coms started to run out of money. The turning point was March 10, 2000. On that day, the Nasdaq hit its peak and then began a long, painful slide. The confidence that had fueled the boom suddenly evaporated and turned into panic. Investors who had been desperate to buy were now desperate to sell. But with everyone selling and no one buying, stock prices collapsed. The greater fool was gone. The crash was brutal. Over the next 2 years, the Nasdaq lost nearly 80% of its value. Trillions of dollars of market value were wiped out. Companies that were once valued in the billions went bankrupt, almost overnight. Pets.com, the company with the sock puppet, went out of business just 9 months after its flashy IPO. Webvin, with its expensive warehouses, burned through over $1 billion before shutting down. Countless other dot-bombs followed, and hundreds of thousands of people in the tech industry lost their jobs. The dream was over. The impact was felt far beyond Silicon Valley. The stock market crash triggered a mild recession in the United States. Many ordinary people who had invested their retirement savings or life savings in tech stocks lost a significant amount of money. The whole episode left a deep scar on the publicist's perception of the tech industry. For a while, .com became a dirty word, synonymous with failure and hype. So, was it all just a pointless bubble? Not at all. This is where the story gets really interesting. While the speculative frenzy was destructive, the underlying technology, internet, is genuinely revolutionary. The bubble, in a strange way, helped accelerate the future. All that investment money that was poured into the sector, even into the companies that failed, built out essential infrastructure. Thousands of miles of fiber optic cable were laid. Data centers were built. Engineers developed new software and platforms. This infrastructure didn't disappear when the bubble burst. It became the foundation for the next wave of innovation. And if you look closely, ULLC today. Biggest tech giants were born out of the ashes of the dot-com bust. Amazon survived. It was one of the few e-commerce companies that focused on steady growth and customer service rather than just hype. Its stock took a massive hit during the crash, but it held on and eventually became the global powerhouse it is today. Google, founded in 1998, also weathered the storm. They had a superior product and, crucially, a viable business model with their search advertising. Companies like eBay also proved their business model was sustainable. The dot-com bubble offers us some timeless lessons. First, it's a powerful reminder that fundamentals matter. A company eventually needs to have a clear path to profitability. Hype, eyeballs, and a cool name are not enough. This is a lesson that every generation of entrepreneurs and investors seems to have to read. Second, it teaches us about the nature of technology cycles. New, groundbreaking technologies often follow a pattern. First, there's a period of irrational exuberance and a speculative bubble, followed by a crash, and then a longer period of sustainable growth as the technology matures and finds real-world applications. We saw it with railroads in the 19th century, with radio in the 1920s, and with the internet in the 90s. Third, it shows the importance of diversification. The people who were hurt the most in the crash were those who put all their eggs in one basket, betting everything on high-flying tech stocks. It's a classic investing principle. Don't put all your money into one single investment, especially a risky one. Today, we're living in a world built on the legacy of the dot-com era. The ideas that seemed crazy back then, like ordering groceries online, streaming movies, and connecting with friends across the globe, are now part of our daily lives. The companies that made it through the firestorm of the bust became stronger, leaner, and more focused. The failure of the first wave of dot-coms paved the way for the success of Web 2.0 companies, like Facebook, YouTube, and Twitter. The story of the dot-com bubble is a fascinating chapter in economic history. It's a cautionary tale about the dangers of greed and crowd psychology, but it's also a story of resilience, innovation, and the transformative power of technology. It reminds us that behind every boom and bust, there are real technological shifts happening that will ultimately change the world. Thanks so much for watching. If you found this look back at the dot-com era interesting, please give this video a like, and consider subscribing for more deep dives into business and technology history. Let me know in the comments if you remember the dial-up days. See you in the next one.